So back in 2001, Enron was, well, this massive, highly profitable energy giant. I mean, they were everywhere. And then suddenly, they just weren't.
Right, it was practically overnight.
Yeah, within just a matter of months, billions of dollars in shareholder value literally vanished into thin air.
Just completely gone.
And it really makes you wonder, how does a seemingly invincible corporation just collapse overnight?
Well, the answer to that actually lies in the sort of hidden source code that drives the entire business world.
Right, which is what we're talking about today.
Exactly. GAAP, or generally accepted accounting principles.
And that's exactly what this deep dive is all about. We're taking this whole stack of financial accounting texts, some historical FASB bulletins and like SEC postmortems to really look at the strict rules of this financial matrix.
Because, I mean, we tend to treat financial headlines, corporate profits, massive mergers, balance sheets, as absolute objective facts.
Right, like they're just hard math.
Almost like gravity or the weather. But they are actually the highly engineered output of a very specific, almost philosophical framework.
Totally philosophical when you dig into it.
It really is. And once you understand the underlying psychology governing these rules, you will never look at a stock price or read an annual report the exact same way again.
So that's the mission for you listening today. We want to give you the ultimate insider's lens into the logic that every major CEO and corporate accountant is basically forced to follow.
And the foundation of this system is, well, it's essentially a corporate constitution.
Right, which is overseen by an independent research organization called the Financial Accounting Standards Board, or the FASB.
Yeah, the FASB acts as the architects of this whole code. So over the decades, they've published over 100 extensive rulebooks.
100? Wow.
Oh, yeah. And these dictate exactly what methodologies companies must use to report their financials.
So it's incredibly strict.
Very strict. And as the business landscape changes, say with the invention of digital software or complex derivatives, the FASB publishes what are called bulletins.
Okay, bulletins.
Right. You can think of these bulletins as like proposed constitutional amendments that update the accounting profession to deal with, new business realities.
Okay, let's unpack this because the foundation of this code, it doesn't even start with money.
No, it doesn't.
It actually starts with how companies are allowed to, well, manipulate time.
Which is wild.
It is, because I always assumed every business just ran their books from January 1st to December 31st, just to keep things aligned with the tax year.
A lot of people assume that.
But according to the text, the fiscal calendar is completely up to the company. Like, as long as it's a predetermined period, they can pick whatever dates they want.
Yeah, it's a purely strategic choice. So take the retail industry, for example.
Yeah.
If you run a major department store, your biggest financial event of the year is the Christmas shopping season.
Obviously. Yeah.
But that season bleeds heavily into January because of holiday returns and gift card redemptions.
Oh, right, because people are bringing stuff back or spending the cards they got.
Exactly. So if you force your fiscal year to end on December 31st, you're essentially severing your most important business cycle right down the middle.
Wow. So you'd be reporting your massive sales in 1 year, but all the refunds and exchanges would hit the next year's books.
Right.
Which would look terrible.
It would look awful. So to solve this, many retailers define their fiscal year as starting on February 1st and ending on January 31st.
That makes so much sense.
Yeah, the full, unbroken picture of the holiday season is contained in one annual report.
Smart.
And, other companies might choose a fiscal year of July 1st to June 30th purely to offload pressure on their accounting departments.
Just to avoid the standard tax rush in the spring.
Basically, yeah. It lets them prep annual reports outside of that crazy traditional window.
Okay, so that makes strategic sense for private businesses. But the sources highlight this incredible domino effect when it comes to how governments set their calendars.
Oh, the government cascade. It is fascinating.
It really is. It's just this giant cascade of dependency. So local municipal governments like your city or town, they generally time their fiscal years to begin exactly 3 months after the beginning of their state government's fiscal year.
Right, and the mechanism driving that delay is basically the budget allocation process.
How so?
Well, a local municipality receives a significant portion of its funding from the state, right?
Yeah, state aid.
Exactly. So by delaying their fiscal year by 3 months, the local government has a window to actually see the finalized state budget.
Oh, so they know exactly how much state aid they're receiving down to the dollar.
Yep. And then they can finalize their own municipal budget without just guessing and hoping for the best.
And the state governments do the exact same thing to the federal government.
They do, yeah.
States begin their fiscal year 3 months after the federal fiscal year starts, just waiting to see how big the federal check is going to be.
It's all just waiting on the guy above you to write the check.
Exactly. But before any entity can even start recording these numbers on their customized calendars, the accountants have to make this massive underlying assumption about survival.
Right, the going concern concept.
Yeah, going concern. Break that down for us.
So when a certified public accountant is preparing financial statements, they are legally required to presume the company will continue to exist for the foreseeable future.
Which sounds like a minor technicality.
It sounds like one, yeah, but it fundamentally dictates how assets are valued.
Let me give a relatable analogy here for the listener, just to break down why this matters so much.
Go for it.
Say a company buys a massive, custom-built robotics system for its manufacturing plant, and it costs $1 million.
Okay.
The accountant records that value, assuming the factory keeps running. But what happens if the company is clearly going bankrupt and, fails this going concern test?
Well, then the entire rulebook just flips.
Really?
Yeah. If there is serious doubt about the company's survival, the financial statements must be reduced to their estimated liquidation value.
Wow, okay.
So that custom-built $1 million robotic system, if the factory closes, literally no one else wants it because it's custom.
Right.
So its value instantly plummets to whatever it can be sold for as scrap metal.
Which is what, maybe $50,000?
Maybe. So simply by dropping that going concern assumption, millions of dollars of paper value can just evaporate overnight.
That is terrifying for an investor.
And it's why the outside CPA firm that's auditing the books is actually required to explicitly state this concern in their certification letter to the shareholders.
So it's the ultimate red flag.
Exactly. It signals to investors that the numbers on the page might be about to turn into literal scrap value.
Okay, but assuming a company is healthy and operating normally, there's another foundational rule from the text that feels highly counterintuitive.
You're talking about the historical monetary unit.
Yes. Because financial accounting only reports in the currency of the country where the company is domiciled.
Right.
And it only records events exactly as they happened in the past.
Yes, exactly as they occurred.
So financial accounting is essentially like looking in a rearview mirror.
That is a really good way to put it.
It's like you're grading a student purely on the test they've already taken in the exact conditions they took them, not on, the potential they have today.
That is a perfect analogy. The statements depict past years without adjusting for the present at all.
Give me an example of how that plays out.
Okay, well, say a company bought a warehouse 20 years ago for $200,000.
Okay.
It sits on the balance sheet today at exactly $200,000.
Even if the neighborhood got really popular.
Exactly. The local real estate market might have exploded. That land might be worth $5 million today.
Oh, wow.
But GAAP explicitly forbids the accountant from adjusting those past reports to reflect current economic conditions.
Wait, so if they are legally bound to look in the rearview mirror and just ignore current market booms, how do accountants process the reality of the present?
Well, especially when things go wrong, right?
Yeah, how do they handle that?
It results in a built-in systemic pessimism. It's formally known as the principle of conservatism.
Okay, conservatism.
The operational rule is actually really simple. Bad news must be recognized on the books as soon as the condition becomes possible and the dollar amount can be estimated.
As soon as it's possible.
Yes, but good news is strictly ignored until a transaction actually occurs.
So they literally rush to record the bad stuff and wait to record the good stuff.
Exactly. They're professional pessimists.
The most striking example of this in the sources is the allowance for bad debts. Like, a company is actually forced to record a financial loss before the loss even happens.
Let's look at the mechanics of that because it's fascinating. Say a company sells $1 million worth of goods on credit. Based on historical data, they know that roughly 5% of their customers will simply default. They'll just never pay their bills.
Right. It's just the cost of doing business.
So the principle of conservatism requires the company to estimate that $50,000 loss and record it on the balance sheet today.
Before they even know which specific customers are going to stiff them.
Exactly. They preemptively take the hit.
That's wild. And the text also mentions the December 26th inventory write-down, which follows the exact same logic.
Oh, yeah?
Like, think about a department store with a massive pile of leftover Christmas merchandise on December 26th. Business reality dictates those items are going to have to be sold at, deeply discounted, distressed prices.
Because nobody's buying a Santa sweater on December 26th at full price.
Right. And GAAP dictates that the loss in value of that inventory, which is called the write-down, must be recorded on December 26th.
Before the items are actually marked down and sold at the lower price.
Right. So the bad news is recognized instantly.
But the good news faces a totally different standard. Let's say a consulting firm lands a massive contract and the client pays them $1 million up front.
Okay, the cash is literally sitting in their bank account.
Yes, but under GAAP, that is not considered revenue.
Yeah, why not?
Because the revenue hasn't been earned yet. Payment in advance might increase the business certainty of the deal, sure, but accounting rules state that until the service is actually provided,
Or the product is delivered to the customer, right?
Exactly. You cannot claim that good news on your income statement. It's categorized as unearned revenue, which is actually technically a liability on the books.
Okay, let's unpack this limitation because the sources point out a massive blind spot here.
Let's hear it.
We're talking about all these strict rules for quantifying dollars, but what about the things that make a company truly valuable?
Like what?
Well, like the specialized knowledge of a tech startup's workforce, or the massive global brand recognition of someone like Coca-Cola or Disney.
Ah, right.
Are you saying those aren't listed as assets on the balance sheet simply because you can't put an exact price tag on the Disney name?
You are hitting on the fundamental limitation of financial reporting right there. In a business sense, the worldwide recognition of a franchise name or the proprietary intelligence of a workforce might be a company's single most critical competitive advantage.
Right. People buy the product specifically because of the Disney brand.
They absolutely do. But GAAP requires what are called quantifiable items.
Meaning a literal, verifiable number.
Exactly. Because you can't put an objective, verifiable dollar amount on something like customer loyalty or employee intelligence. Accounting simply pretends it has no value on the books.
So it's just invisible to the accountants.
Basically. Unless a trademark or franchise name was specifically purchased from another entity for a set verifiable price, it is generally excluded entirely from the balance sheet.
But if companies are forced to leave their most valuable assets entirely off the books, how can investors actually trust the numbers that do make it onto the page?
Well, trust is generated through two highly enforced mechanisms: consistency and full disclosure.
Okay.
Because when an accountant prepares financial statements, GAAP often gives them multiple valid ways to calculate something. They actually have to make a choice.
Right, like choosing between LIFO and FIFO for inventory.
Yeah.
I always hear that thrown around in business news. Last in, first out versus first in, first out.
Yeah, that's a classic example.
Does that choice actually change a company's bottom line?
Oh, it drastically changes the bottom line. So imagine you run a business selling copper wire, and inflation is driving the cost of copper up every single month.
Okay, so costs are rising.
You bought a spool of wire in January for $10, and then you bought another spool yesterday for $20.
Got it.
Today, you sell one spool to a customer. If you use LIFO, meaning last in, first out, you record the cost of the item you just sold as $20.
Ah, the more expensive one.
Right.
So your expenses look higher, which means your profits look lower on paper.
And what does that mean for taxes?
Oh, it ultimately saves you money on your corporate taxes because your profit looks lower.
Exactly. The appeal of LIFO during inflationary periods,
Right.
GAAP lets you choose that method. But the rule of consistency states that once you decide on LIFO, every successive set of financial statements must employ that exact same methodology.
You can't just flip back and forth.
No, you cannot switch to FIFO next year just because copper prices dropped and you want to manufacture better-looking profit margins.
Because then investors have no idea what the trend actually is. You'd be comparing apples to oranges just to hide a bad quarter.
Right. Valid comparative analysis relies on strict consistency. Now, there are rare times when a major change in accounting methodology is genuinely necessary to reflect the business better.
Sure.
But when that happens, the full disclosure principle kicks in. The accountants cannot just quietly implement the change.
They have to broadcast it.
Very loudly. They have to go back and completely redo prior financial statements using the new method so the reader has a valid reference point.
That sounds like a lot of work.
It is. And they have to print the word restated right across the top of those new numbers. Plus, they must include a prominent footnote detailing exactly why they changed methodologies and the precise dollar impact it had on the results.
Now, the sources mention that this level of disclosure is triggered by a concept called materiality, which is A totally relative concept.
Yeah, materiality is defined as any event, change, or error that would alter the judgment, analysis, or perception of a reasonable reader of the financial statements.
So it's basically like a speeding ticket.
How do you mean?
Well, to a broke college student, a $200 ticket is incredibly material. It ruins their month. They have to skip meals to pay for it. It changes their whole financial picture.
Right, definitely.
But to a multi-billionaire, a $200 ticket is completely immaterial. It doesn't affect their overall financial health at all.
That scales perfectly to the corporate world. A $20 million inventory error would be disastrously material to a small regional business. It would demand full disclosure and restatements.
But for a giant company,
A $20 million rounding error within a multinational enterprise generating $50 billion in revenue. It's totally immaterial. It won't change a single investor's judgment.
okay, so we have these guardrails: consistency, disclosure, materiality. But the system really relies on the assumption that the people at the top are actually playing by the rules.
Yeah, and that's a big assumption.
What happens when they just decide not to?
Well, when trust breaks down on a massive scale, you get systemic shocks that force the federal government to rewrite the rulebook.
Which brings us back to Enron.
Exactly. The defining modern example is the Sarbanes-Oxley Act, passed by the U.S. Congress in 2002.
So this was the direct fallout from the Enron scandal we talked about at the top of the deep dive.
Enron, WorldCom, and just a whole series of massive corporate frauds. They revealed that executives were using highly complex off-balance sheet financing to literally hide billions in debt from investors. So the resulting legislation, which was named after Senator Paul Sarbanes and Congressman Michael Oxley, mandated incredibly strict improvements to corporate governance and the entire audit process.
From the text, it is essentially killed the "I didn't know" defense for executives.
It totally did.
Because under Sarbanes-Oxley, or SOX, the CEO and the chief financial officer must personally sign a legally binding letter certifying that the contents of the annual report are true.
Plausible deniability was just eliminated. They also have to legally certify that the company's internal controls are effective.
So they can't just blame the guys below them.
Nope. Claiming ignorance of deceptive practices by lower-level employees is legally no longer an acceptable defense. The act also specifically targeted the exact mechanism Enron used, mandating extreme transparency regarding any off-balance sheet financing.
And it completely overhauled how the board of directors operates, right?
Yeah, massive changes there.
Like, the audit committee of the board, which oversees the outside accounting firm, is now legally required to have at least one member with a professional background as a certified public accountant.
Which is wild.
It seems insane that it wasn't a rule before. How can a committee provide intelligent oversight of complex financial audits if no one in the room has any background in accounting?
I mean, hindsight makes the flaws obvious, right?
Seriously.
The act also empowered shareholders by giving them a proxy statement that allows them to vote for or against the outside audit firm. It created a mechanism to actually fire auditors who are getting too cozy with management.
Here's where it gets really interesting, though. The detail that really highlights the absurdity of the pre-2002 corporate world is the reform to compensation committees.
Oh, the compensation committees?
These are the board members who decide what the CEO and executives get paid. You're telling me that before SOX, subordinates could literally sit on the compensation committee and approve the bonus packages of their own bosses.
Yes. The conflict of interest was just staggering.
That's a huge conflict of interest.
Lower-level employees were effectively in charge of determining their CEO's multi-million-dollar bonuses, or coworkers would mutually approve each other's massive compensation packages.
Is the Wild West.
It really was. Sarbanes-Oxley shut that down immediately. It required that the compensation committee consist strictly of outside, independent directors who have no employment ties to the company.
Which just makes sense.
Right. It also forced out these career board members who were serving on like 7 or more boards simultaneously just as favors to friends because the increased personal liability made it too risky to not pay close attention.
So executives are heavily penalized and personally liable for lying about the past now. But part of a CEO's job is to look into the future, right?
Absolutely.
They have to get on earnings calls and project growth.
Yeah.
How do they do that without stepping into a legal minefield if they just end up being wrong?
So they rely on a piece of legislation that actually predates SOX. It's the Private Securities Litigation Reform Act of 1995.
Okay, 1995.
Yes. This established what is known in the business world as the safe harbor provision.
Harbor, right.
It protects the company and its executives from legal liability resulting from statements made to the public that turn out to be incorrect, provided those statements were made in good faith based upon what was known at the time.
Okay, so let me make sure I've got this. If a CEO is on a quarterly conference call with thousands of investors and they provide guidance,
Right.
like saying they expect a 15% profit growth next quarter based on their current sales data, if the actual growth only comes in at 5%, under the Safe Harbor Act, the CEO cannot be sued for defrauding investors.
As long as that initial projection was a good faith estimate, no, they can't be sued.
Wow.
I mean, shareholders will absolutely punish the company by selling the stock because the management's forecasting isn't credible.
Sure, the market reacts.
But the CEO won't face SEC fines or class action lawsuits for simply being wrong about the future.
The sources actually include a direct quote from the 2014 Walt Disney Company annual report about this, and it reads like literal legal armor.
It's pure boilerplate.
It explicitly states that they make forward-looking statements about strategic initiatives and economic developments, but firmly declares these are based on management's views at the time, and they undertake no obligation to update them.
Standard protection.
And they end it with this ultimate sign-off. There can be no assurance, however, that our expectations will necessarily come to pass.
Exactly. Predicting the future is legally protected, but sometimes accountants have to deal with massive uncertainty in the present.
Right.
And the 2008 financial crisis forced a massive shift in how GAAP handles unknown valuations, specifically regarding the subprime mortgage collapse.
Because banks suddenly held trillions of dollars in these complex mortgage assets, the market completely froze, and nobody actually knew what anything was worth.
The solvency of the entire global financial system depended on finding a rational way to value these totally frozen assets.
So what did they do?
In response, the FASB issued a Statement of Financial Accounting Standards, specifically SFAS Nr. 157.
Okay.
This document established the rules for fair value accounting. It defined market value strictly as an exit price.
An exit price, meaning what?
The exact amount a company would receive to sell an asset in an orderly transaction between market participants at that exact moment.
Okay.
And to standardize how companies calculated this exit price, SFAS 157 created 3 classifications, or levels, of assets.
Okay, let's break these down. Level 1 is pretty straightforward from the reading. These are assets with publicly quoted prices in active markets.
Right.
So if a bank owns shares of a standard stock listed on the New York Stock Exchange, they can look up the exact real-time price instantly.
Exactly. Level 2 requires a bit more work. There may not be a real-time quote for the exact asset, but there is available solid market data for identical or highly similar assets.
So the accountant can just sort of extrapolate a highly accurate price.
Basically, yes, but then there is level 3.
Yeah, and this is where I get stuck, because the sources define level 3 assets as having no direct quotes or information available to value them.
Not at all.
So if level 3 means there's absolutely no information available, how does a bank even begin to justify a dollar amount to the investors reading their financials? Aren't they essentially just flying blind?
This remains the most controversial aspect of fair value accounting. Categorizing an asset as level 3 is, well, it's like trying to value a custom-built, one-of-a-kind mansion in a neighborhood where no houses have been sold in a decade.
You can't just check a real estate app for comparable sales.
Right. The bank is openly admitting the market is entirely illiquid. To find an exit price, they have to rely on their own internal, highly complex mathematical models.
Wait, what kind of models?
Typically, discounted cash flow models. So they have to guess how much cash that asset might generate over the next 10 years.
Oh.
They estimate the mathematical probability of borrowers defaulting on those specific loans. They factor in hypothetical interest rate changes, and then discount all of those guesses back to a present-day value.
So they were basically saying, the market is dead, so just trust our internal math.
Yes, which is precisely why the categorization system is so vital.
I see.
By forcing companies to clearly label an asset as level 1, 2, or 3, the reader of the financial statement has immediate insight into the underlying risk of that valuation.
Right. If you see a bank with massive amounts of level 3 assets, You know that billions of dollars on their balance sheet are based purely on management's internal assumptions, not hard market data.
Exactly. It is the full disclosure principle adapting to a crisis.
Man, we have mapped out some serious territory today.
And really have.
We started by looking at how companies use the fiscal calendar strategically to capture business cycles, and that crazy domino effect of government budgets.
Waiting on those checks.
Yeah. And then we explored the deep-seated conservatism of accountants, forcing companies to record bad debts and inventory write-downs before they even happen.
The professional pessimists.
Right. We saw how the massive deceptions of Enron birthed the strict accountability of Sarbanes-Oxley, and finally, how the 2008 crisis forced the creation of the three levels to value completely frozen assets.
The overarching takeaway is that accounting is not static arithmetic.
It's really not.
It is a dynamic, constantly evolving rulebook designed to catch up with human behavior and complex economic realities.
Which is fascinating.
And for you listening, this provides an incredibly practical toolkit.
Definitely.
The next time you listen to a business podcast and hear a CEO issue quarterly guidance, you'll know the safe harbor provision is protecting them.
Or when you see a company take a massive sudden loss on inventory, you'll know they are applying the principle of conservatism. Which leaves me with one final thought to ponder. If GAAP rules strictly forbid companies from quantifying the value of their employees' knowledge or their massive brand names simply because they aren't objective numbers, are modern financial statements actually failing to capture the true worth of a 21st century business?
It's a great question.
In an economy completely driven by ideas, innovation, and human attention, it is entirely possible that the most valuable things in the world are the exact things the source code of accounting is forced to ignore. Think about it. We'll see you next time on The Deep Dive.